Good afternoon, everybody. Welcome to my channel, Data Driven Decisions. Today I finally changed or rebalanced my big retirement fund that I hold in Vanguard. And this is the sheet that I use in order to execute the process. Um, it starts off with this input page where these are all the funds of which I'm in, and I just got to enter in the current price and the shares that I hold. And then that ends up coming right here, and I just paste special and paste values into the price into the pre-shares, and then right here I put in how much money I have in the account, and then the rest gets taken care of, starting with the target amount for each value, the target shares, and then the difference between the pre-shares and the target shares is your buy sell, and that's what I have to execute on. At first, what I do, as marked in yellow, is I do all the sells. So anything that's negative, um, I execute it, and I first sell everything, and then I end up going down the line in green, you see, and that's when I buy things that need to be bought. And so, I don't want to show the Vanguard. I don't want to show my accounts on that front, but only in Excel and Power BI. But this is the post amount that I have, and looking at the last time I did it, which was 2 years ago, I only had 59,000 in the account. Now I have 76. So the stock market has really been friendly over the past 2 years. I also was just getting sick and tired of losing off of bonds, and I ended up, as you can see, like with BND zero, I ended up selling all of my bonds at one point, and that wasn't a smart decision. That was not sticking with the plan. I probably ended up winning in the situation because I sold the bonds, and then I bought just more into the broad stock market ones like VTI. The ones that I really had to sell were VEA and VTI. Those were what I bought into. It probably ended up, helping me more than hurting me. But nonetheless, I went back to the original plan of the original asset allocation, including the bonds. So as you can see with, BND, with B, BNDX, I bought a lot and bought, rebought into those funds. So now I'm back to the original target allocation, which, as I've shown in a previous video, it just does as good as your typical blended stock market index, which includes stocks and bonds. It's definitely heavily weighted on the stock side. I think I have that information. You can see stock is 91%, fixed income is only 9%. This is really the breakdown of what this mutual fund that I've created for myself is consisting of. And it's definitely earning me a lot of money. As you can see, in 2 years it's given me $11,000. So I'm happy with what I'm doing. I looked at my stuff in personal capital. If I look at it in personal capital, I'm just doing as well as a market blended index fund. So I'm just getting my fair share. I don't have rock solid, uh, gains, nothing through the roof, just in the upper, 60 to 80% percentile, just getting my fair share, but, on average, doing better than most people. Most people are in high cost, actively managed funds, and they're always going to be losing because of the expenses that they have to pay. They're probably just going to get market average minus expenses, which averages out to the market average minus expenses, whereas I just get the market average. With rock bottom expenses, it's pretty much just the market average with very little taken out after. Um, so, it's a good plan. And so, yeah, I'm back to my normal asset allocation. And, it's good to rebalance like once every 2 years. Um, when it comes to like losses, it takes, like a $2 gain to offset a $1 loss. So you want to look at it once every 2 years because that's when the odds of it being a big gain are in your favor. For example, these 2 years of when I last did it, I've gained about $17,000 and I'm really happy about that. The next time I probably rebalance is going to be in another 2 years. You don't want to do it all the time. The best advice to investing is come up with an investment allocation, stick with it, and then rebalance once every year or two. And, you'll get your fair share and you'll be forcing yourself to buy low and sell high just within your own mutual fund or basket of funds that you have. As you can see with this, the high flyers, I ended up selling like VTI, VEA, EFV, these high flyers I sold. And then the big losers like small stocks, small value, which has been losing, I still trust in it. I think, the future is bright for those because the future hasn't been so bright for it for the past 15 years. So I feel like good times are ahead for small value and only just because it hasn't been good for a while. So it's Gordon equation is rather high because its prices are low and affordable and probably undervalued. So whenever things are doing bad for a long time, it's a good time to get back into it, especially if it's something with a long track record of being successful, such as the small value factor. So I'm very heavily weighted in small value with my company 401k. It's pretty much all small value. So it certainly hasn't given me good returns, but I believe in that edge. The less glamorous, the less entertaining stocks are the ones that going to give you higher returns simply because they have to in order to attract buyers. Because they're not as entertaining as the Netflix or the high flying, Amazon or Alphabet. Those pay a fee for being entertaining. They have a speculative bias in its favor, so it's always overpriced. So it doesn't have as good as outlook in the future. Whereas something that isn't popular, no one really knows about or cares about, it's probably something that is underpriced. And in order for it to even have those shares bought, it has to produce higher returns than what the market or growth stocks give. So, the fact that small value has done bad for the past 10, 15 years means that it's probably going to do good for the next 10, 15 years. And I'm really placing my bets in that favor. It's low, can't go much lower, because it's had a low time for the past 10, 15 years. So, there's a cap on its losses, but whereas its gains, it could be twofold or threefold. So it's got a higher gain potential and a much lesser loss potential simply because it's been underpriced for 10, 15 years. It hasn't been producing much value. So they're not popular at all. And everyone thinks that edge is gone, but it probably just it comes and goes with a higher risk asset allocation. When you're in small value, the risk is higher. So you're going to have to suffer these long, extended period of losses. And that's what the returns are all about is, being somebody who can bear that high risk, be someone who can bear that high risk. And, that will give you the higher returns, So, it's your job if you're going to be, investing in small value, something riskier but higher returns, to end up going very long periods, maybe 10, 20 years with it losing and being below par. But when that happens, that always means that sunnier skies are ahead and it's kind of due for high returns. So you know, most people never buy funds when they're low in price. When as you think of anything else, when you buy groceries, you buy more when it's lower price. But people tend to be afraid of things that are in low price. With the stocks, it's we always got to battle our reptilian brain when it comes to investing, because that's what hurts us. Our also, like, our empathy brain, when you feed off of the moods of other people, that's the worst advice you can do. You want to really be against the grain. When people are really mad and going crazy, and um, speculation is in the air and stocks are really gaining, that's kind of when you want to be heavy in bonds. Whereas when times are really low and nobody wants to talk about stocks, or nobody owns stocks because they've done so bad, that's when you really want to have a high allocation in stocks. You really just want to go against the grain in investing. It's the same goes for the news. You don't want to listen to the news. You want to go against the news. Those CNBC, Bill Kramer, stuff like that. That always is very bad advice. If you bet against it, you probably do much better. But what you really need to do is just ignore all news when it comes to the finances, because most of it is just bad news telling you to react to something. When if you do that, you're going against professional institutional investors. Basically you're going up against Serena Williams in a tennis match, and yep, you're going to get beat by a woman, and it's not going to feel good. So anyway, you know, I'm happy with what I did. This is an allocation I've had for a long time, for about 4 years. I'll just keep it going. I like what I did, so it's given me good returns so far. So anyway, that's it. Have a good one. Bye.